So before we get started, just a little legal disclaimer. Nothing in this webinar should be construed as investment advice. You need to contact your own investment, tax, or legal advisor before making any types of trades or decisions. Everything provided in this webinar is for educational purposes. All right, so if you have any questions on that, you can email us, but this is a pretty straightforward disclaimer. And a special thanks to eSignal, the provider of all of our stock charts that you'll see in this class, and Trade Ideas, the provider of our stock scanners. Those are our two partners, and we absolutely love working with them. So I appreciate their support in helping us get everything set up, both the way we run our platforms for trading and for all the images that you'll see in this webinar. All right, so what we're going to teach you here today, first of all, what is day trading? All right, second of all, how to set up a day trading account, the importance of paper trading, learning how to manage risk, how to choose the right stocks to trade, because out of the thousands of stocks available to trade on any given day, there's really only a select handful that are actually good for day trading. All right, we're also going to show you how to set up your charts and how to read chart patterns, how to make a watch list, how to buy and sell shares, and we're going to talk a little bit about creating a trading strategy, and then we'll wrap up with some final words of wisdom. All right, so if anyone has questions while they're watching this webinar, you're welcome to write them down and email me, ross@warriortrading.com. So the things that we're going to teach you today, why are they important? In order to be a profitable trader, you must be able to find momentum stocks with home run potential. You need to be able to find safe entries. An entry is a low risk opportunity to enter what could potentially be a strong momentum stock. All right, and you have to be able to manage your risk and understand your risk reward ratios on every single trade you take. And ultimately, you're going to need to create a trading strategy designed around the time of day where you have the best performance, the types of stocks that you're most successful trading, and the patterns that you seem to find the most obvious and that resolve the best to a high amount of volume. All right, so what is day trading? We'll just get started here right with the basics. A lot of you guys may know this, but day trading is the simple process of buying and selling shares of a stock within one day. So if you're day trading, you're buying shares with the intention of selling within a few hours or even sometimes within a few minutes. That means with a day trade, you have to use a larger position size in order to profit from a small move in the stock. Now, in the US, we have the pattern day trader rule, and that means you're limited to 3 round trips in a 5-day rolling period. So a round trip is when you buy and sell. All right, so the pattern day trader rule says you can't do that more than 3 times in a 5-day period unless you have a minimum of a $25,000 balance in your account. And for a lot of new traders, that's an obstacle to trading. $25,000 is a lot of money, especially if you're right out of college, or even if you're not, it's still a substantial amount of money. So that's something to be aware of. And one of the things that I would say is we've had a lot of students who will come to us and say, how much money do I need to start trading? And the short answer is $25,000. But really, the truth is that you need knowledge, because if you have $25,000 but you don't have any skill, you're going to lose that money. I mean, you have a 90% likelihood of losing that money. So more important than the money is the skill. And that's why we would encourage all of our traders, both our students and the traders in the chat room, to focus first on paper trading in a simulated environment to get a feel for the strategies and build up your skill while you continue to save money. All right, so why would you day trade? Well, as a day trader, our goal is to make money on relatively small moves in a stock, but the only way to really do that is to use larger positions. And these positions typically are going to be larger than what you might feel comfortable holding as an investment due to single stock exposure. You don't want to put all your eggs in one basket, but day traders actually do that a lot. And that's why day trading is considered so risky, because you do put a large chunk of your portfolio into one stock but you mitigate that risk by trading for very short periods of time. So you'll be holding and exposed to that amount of risk maybe for only a few minutes or a few hours, but not for several days or weeks the way you would with a longer term investment. Now, a $10,000 investment versus a $10,000 trade. So on a $10,000 investment in a mutual fund, you would look for maybe 5 to 7%, 5 to 8% return annually. So that means you're looking at $500 to $700 over the course of the year, which is $50 a month. Now, if you take a $10,000 position as a day trade, we're going to be aiming for more like a 5 to 7% winner within a few hours. So that's $500 to $700 profit in one day. But that requires putting that entire investment into one position, which is against safe money management principles for investing, right? So this is the pros and cons. Now, if you're in a position, and I of course do what's best for me, and I can't say what's best for you, but if you're in a position where you have some money set aside in mutual funds and that's growing at a slow and steady rate, that's great. But then if you want to be more speculative and more aggressive, that's what day trading is for. And what we look for are stocks that are going to move. Finding a 5% mover intraday isn't that easy. And what's even harder is actually capturing that profit, right? We might see a stock that's moving, but then to be able to lock in that move and profit is, of course, the ultimate goal for any trader. So we have to learn first to identify the type of stocks that are going to make those moves and how to enter those stocks in a safe way. So when we lose, which is inevitable that we will lose sometimes, that we don't lose more than we win on average. And that's really the most important thing. All right, now the stocks that move, they're going to move because they have a reason to move, whether they had positive earnings, some type of breaking news, or something of the like. All right, so our job as traders is to find stocks that are moving, to find the volatility, to understand the catalyst, and to recognize big potential, home run opportunities, and then capitalize on those opportunities. So some of the tools and the overhead of a day trader, you're going to need stock charts. You may want stock scanning software. You may want news software, streaming news, a subscription to a news radio. You may have chat room subscriptions. And of course, you're going to have to pay your broker every time you buy and sell shares. All right, so the overhead can easily get to $300-400 a month, if not more. And as a new trader, when you're paper trading, you want to keep your overhead as low as possible. So, it just doesn't make sense to sign up for all of the best software when you're not actually profitable yet, right? So take advantage of some of the free services that are out there, even if it's maybe not something you would use when you're making money. If it's, enough to get you by right now, then that's fine. You don't know how long the learning curve will be for you. For me, it was 18 months. So, during 18 months, I'm glad I wasn't spending $500 a month on software, because I was, that just would have been too much. So in your early days as a trader, you want to keep costs low and be smart about what you're going to spend your money on. Okay, so as a day trader, I look for these home run potentials. These certain setups, and there are times where we see stocks make, anywhere from 10 to 100% moves in a matter of minutes. I mean, we've seen 10,000% runners, and we've seen 1,000-point stock market crashes. In the time that I've been trading, I've seen a lot of different levels of volatility. And ultimately, my success as a trader has always come back to the fact that I've learned how to manage my risk. So I always know when I take a trade how much I'm risking. And I know some stocks, it's okay to risk more because they have home run potential. This is a stock that we traded that we bought this at $2.50 and it went up to $5.82 in 20 minutes. Over 100% mover in 20 minutes. I mean, that's incredible. That is absolutely incredible. And of course, you wouldn't want to invest $100,000 in a trade like this. But when we look for these types of opportunities and we can invest or trade, $5,000 or $8,000, and we understand what we're risking and we know the reward potential, if we can do this repeatedly and build a strategy and a system around trading these types of stocks, we can do very well. All right, so that was a trade that we took almost $1,400 profit in 25 minutes. Market opens at 9:30, and by 10 a.m., I was up over $1,000. That's the daily goal right there. And that's not something that's really hard to achieve if you know how to trade the right stocks. But of course, that's the struggle for a lot of new traders, is understanding the right stocks to trade, finding them in real time, and managing somehow not to allow their losers to get out of control. So we asked our students on this trade who was profitable. And we found that 91% of our students in the room on that day that traded this stock made money on it. That's incredible. 91% of the traders in our room made money on this stock. But the reality is 90% of day traders who try to trade will fail. They're going to lose their money in their first year and they'll quit. And this isn't because they weren't able to find good stocks to trade. It's because they were unable to manage their risk. They had poor stock selection and they lacked education. So when we hear the statistic that 90% of traders will fail, well, it certainly makes it seem bleak if you're thinking about starting to trade, knowing that the odds are really stacked against you. But recognize that the majority of those traders who fail did not invest in a trading course. They didn't watch a class like we're teaching right now. They didn't read books. They just jumped into the market thinking that they could make a little money on the side, and they were wrong. Okay, so if you're a new trader, the first thing to focus on is your education. Money is secondary. Making money, losing money, that's secondary. First and foremost is building your education, building your skill. All right, so if you're interested in swing trading, that allows you to be involved in the market, holding stocks for 3 to 5 days without having the need to be chained to your computer. So that's a way to kind of introduce yourself and segue hopefully towards day trading, but if you're not quite ready or available to be in the market full time. So the swing trading strategies, those are taught by Jeff, and those are all available on the trading course page. You can see them on our website. So on that day, and on almost any particular day when we ask students how they're doing, we've seen an 80% success rate among our trading course students. Now, that represents over 8 times the average success rate of a day trader, which is only 10%. So what's different about what we're doing? We're teaching students how to trade. We're teaching you the exact details of the trading strategies that we've proven are successful. And of course, they're not going to work for everybody, but we're trying to give you every advantage to be successful. All right, so now that you know what day trading is and you decide you want to open an account, how do you go about doing that? All right, so we'd recommend first that you start with a demo account where you can trade with pretend money. As a beginner, you will make mistakes. It doesn't matter what you're learning, anything that you're learning, you're going to make mistakes as you learn. That's part of learning. All right, so make those mistakes in a simulated account. Right? You don't want to lose money, real money, on beginner mistakes. That just isn't smart. Okay, you wouldn't start learning to drive a car that's brand new. You start on an older car. You know you're going to make mistakes. That's life. All right, it's the same with day trading. All right, set reasonable expectations and start slow. Open a demo account. A lot of our trading course students use Ameritrade. Ameritrade offers unlimited paper trading. It gives you the ability to practice, to be in the market in real time. You can see the charts, you can see the level 2, and you can participate buying and selling without risking any real money. That's really good experience. Okay, now there are different kinds of stockbrokers, all right? And there's full service brokers like Ameritrade and E-Trade, and those are brokers that they certainly cater to retail traders, but they also offer a lot of convenience features. You can do automatic bill pay out of your brokerage account. You can write checks. You can have a debit card connected to your brokerage account. They also often have great charts. They offer scanners. They have research tools. So they're really, a full service broker, and they give you a lot of conveniences, but you're going to pay a little bit more for those. As a new trader, since you're not probably going to be trading 30 or 40 times a day, it's okay to pay a little bit more. And the cost that you're paying more is per trade. Their commissions are going to be higher. So as a new trader, that's okay because by being with a full service broker, you actually have the advantage of not having to separately pay for, really nice charting software, really expensive scanning software, stuff like that. So you can roll some of your costs just into the commissions being a little bit higher. But when you get to the point where you're trading really actively, it's going to be important to be with a broker that really caters to day traders, to very active traders. Okay, and so for live trading, we recommend Speed Trader, Lightspeed, and for traders under $25,000, SureTrader is also an option. Those are the brokers that we've used and we've had good experiences with, so I would encourage you to check those out. But for paper trading, TD Ameritrade, that's the best place to be. All right, now let's talk for a minute about the importance of paper trading, just to really emphasize this. My cost of learning was over $30,000 trading untested strategies. I had some really, really bad days in my first 18 months trading. And I certainly had days where I made thousands of dollars, but I also had days where I lost thousands of dollars. And over the course of 18 months, I was losing more on average than I was winning. In my eagerness to make money trading, and I was trying as hard as I could to make money, I bypassed the critical step of paper trading. I never really wrote down a proper day trading plan or a strategy. I didn't have historical data to back up that strategy. I was really just kind of shooting from the hip, practicing a little of this and a little of that. And it came at the cost of my account. I depleted my account during that time, and it was, it was a really hard time for me emotionally. I was working so hard to be a successful trader, but I wasn't finding any success, and I was getting really frustrated. And at the time, I wasn't aware of any good opportunities for educating myself. I wasn't able to find a class like the one that we're offering now. So I really felt like I was on my own. And there were times where I would ask myself, can I withstand another $1,000 losing day? I mean, at what point do I just throw in the towel? But I felt so financially invested in it because I'd already lost $30,000. And I was embarrassed. I didn't want to tell people about it. And there was this weight hanging over my shoulders. And, I'd really like to save you guys that experience. It's not fun. I think to a certain extent, it's an experience that almost all traders will go through, but I think it can be avoided or at least, mitigated if you can start by paper trading. So I'd really encourage you, whether you're down 1,000 for the year, 10,000, or you're up 10,000, if you're feeling insecure about your strategies right now, there's really no reason to continue trading with real money. Switch to the paper trade account and ask yourself these 3 big questions. What's your strategy? How do you manage risk? And what's your goal for the next 6 months? All right, so what's your strategy? What setups do you trade? And what stocks do you trade? And what are the statistics on those strategies? The only way to know this is by tracking your trades. Right? What time of day do you trade? When are you most profitable? I personally make the most money in the first hour of the day on stocks under $10. I know that that's my wheelhouse. That's where I perform the best. Even though I have some really big winners on stocks between $20 and $100, I also have some big losers that weigh down those winners. Now, how do you manage risk? What is your current risk-reward ratio, your average profit-loss ratio? Right? What's your max loss on a day before you say, I gotta throw in the towel and turn the computer off? Do you even have one, or do you just keep trading? Do you have profit targets where when you're up X amount, you sell half and adjust your stop? These are the rules that are going to govern every trade that you take. From the type of stock, to the pattern, the time of day, to where you set your stops and where you set your profit targets. And what's your goal for the next 6 months? Right? Now, setting goals is really important. It's a benchmark. You draw that line, you say, this is where I want to be in 6 months. And then when 6 months come, if you're not there, that's okay. But you can evaluate where you are and track your progress. Okay, now, during the time that you're paper trading, education comes first. You want to educate yourself. You want to be an independent trader. You want to be your own ATM machine where you can find stocks, trade the setups, and generate income day after day. Now, I trade for income. I'm not a speculative trader trying to make $1 million by, buying some random penny stock or option call. I'm trying to make $500 to $1,000 a day consistently for income. And I've proven that that's achievable, right? But you have to understand what your goals and what you want to get out of the market. What I want may not be the same for everyone. But if you want to trade for income, it's really not a good part-time hobby because it takes so much time and energy to learn that, by the time you've achieved the level of skill necessary to be profitable, you're going to be able to make so much money, there's no reason to do it part-time. It wouldn't even make sense. And if you're trying to learn just part-time, it's going to take a very long time to get to the level where you can be profitable. So, when you're trading, you're an entrepreneur. You're running your own business, and you want to have that sense of independence and that sense of confidence that comes with that. But that means you have to have plans, business plans, trading plans, and you need to be organized and disciplined, and you have to follow them. All right, so one of the important things is to track all of your trades and to start start data mining your own performance and understanding what you're really good at and what you need to work on a little bit more. All right, now there's, you could say this 1,000 times, but you should never trade an unproven strategy. Right? When you know a strategy has a 65% success rate with a 2-to-1 profit-loss ratio, you understand the risk, you understand the ins and outs of it, that's something that you should be trading live. If you think, well, maybe I'll just buy some option calls on, XYZ because I heard this or that, that's not a strategy. That's just gambling with your trading account. And gambling is not going to sustain you in this market. You may get some lucky wins, but you will not be able to make a career on luck. So you want to set realistic goals. And for the first 3 months, you shouldn't expect to be profitable. If you are, that's awesome. But if you're not, you shouldn't be disappointed because really you should be paper trading. Trading is a process where you survive until you learn. And you learn through experience. So the more time you're sitting in the chair, watching the computers, watching the scanners, watching the charts, the better you'll get. All right, so that's something that we tell a lot of students is just simply learning to tread water in the market is key, because the longer you sit in the market, the better your opportunity for success, because you'll learn. You'll just become to, start to understand the chart patterns and the stocks that are former runners and the ones that work the best and the ones that don't work so well. And a lot of that is just something that's gained through experience. But you have to build your foundation. Okay? The market will be here. If you can make money in a simulated trading account, you've built the skills to make money in a live trading account. So, there shouldn't be any rush or, sense of urgency to make a ton of money. This is a strategy and a skill, day trading, that can last you a lifetime if you have the patience to go through the process the right way. And if you don't, then you may not make it to the point where you're able to get past that learning curve and be successful. And I know that we've had some traders that come in and within a couple of weeks they're trading profitably, making a lot of money, and that's awesome. That wasn't the case for me though. For me, it took a lot longer. So everyone's unique in terms of the learning curve, and the most important thing is building your foundation. Paper trading is the best way to do that. Okay, now when it comes to day trading, risk management is number one. And ultimately, what separates good traders from bad traders and the good trades from bad trades is risk management. So why is it that 90% of day traders fail? If we know that that's a statistic and that's a reality, we need to dig into that. Why is that the case? And what can we do to avoid being, part of the 90%? Well, the reason is they don't utilize risk management at all. Using proper risk management principles, you can make money and be wrong more than half the time. Being successful as a trader is not about picking the right stocks 80% of the time. It's about knowing what you're risking and knowing how to lose. I mean, that's it. It's about learning how to manage your losses. So every time you take a trade, you have to know how much you're risking. Whenever I talk to a student who says, "Oh man, I just lost $5,000, or I lost $10,000," the first question is, well, how much were you risking on that trade and what was your profit target? And they'll say, I don't know. I got into this and suddenly I was down $500 and I just kept holding it, right? They were only in the trade to make a couple $100. They didn't even really know. And suddenly it turned into this huge loss. And for some traders, a catastrophic loss. And it all comes back to the fact that they didn't plan the trade. They were shooting from the hip. They got into a bad situation. They panicked. They didn't know how to get out of it. And it just got worse and worse and worse. Learning to manage risk is what will make you a successful trader. So, imagine if all your losses were only $10, but your winners were $90, right? You could lose a lot and just hold out for those $90 winners because they'll make up for all the losses. So with that type of profit loss ratio of 9-to-1, if you're successful 15% of the time, you're making money. So success, again, is not about being right 100% of the time. It's about learning to cut your losses when you're wrong. And we've talked quite a bit here about profit loss ratios. Okay, so a profit loss ratio, it's simply your average winner versus your average loser. You need a minimum, really, of a 1-to-1 ratio. And you want to aim for 2-to-1 or 3-to-1 and aim as high as you can. The high profit loss ratio means you can be wrong a lot and still make money. So this is the breakdown here of profit loss ratios. If you have a 2-to-1 profit loss ratio and you're right 33% of the time, you're break even, not including commissions. If you have a 1-to-1 profit loss ratio and you're right 50% of the time, you're break even. And if you have a 1-to-2 profit loss ratio where you lose more than you win on average, you need to be right 66% of the time to break even. Okay, so you can see how you can set the bar against you. You can set the bar so high that it's almost impossible to succeed just because of the way you establish your profit loss ratios. But a lot of traders are trading and they don't even know about profit loss ratios. They're not even thinking about that. They don't know what their actual statistics are because they haven't taken the time to track those results. And that's data that is extremely important in designing your trading strategy and ultimately in your success. So let's think about a trader who loses money even though he's right 90% of the time. He takes 10 trades in a day and he risks $100 on the first 9 trades and he wins on the first 9. He's up $900. He was risking 100 to make 100, 1-to-1 ratio. He made $900. And then on the 10th trade, he decided to risk $1,000 and he lost. He's now a losing trader despite being right 90% of the time. He failed to manage his risk properly. And what this suggests is that success in trading is not about picking the best stocks, but about managing your losses properly. And that takes a little bit of pressure off you. You don't have to be the best stock picker out there, but you need to be really good at managing loss. So what we're going to try to do is put the statistics in our favor. Know your statistics, right? Understand your average winners and your average losers. If you go in and you realize that your average losers are $200 and your average winners are only $150, that's a problem. And you need to start making adjustments to improve that ratio. But if you don't know those ratios, there's no way to, know what you need to work on. Gamblers think about profits and traders think about risk. So we have to always think about the risk that we're taking on any given trade. All right, so your first piece of homework is to begin tracking all of your trades in an Excel document. All right, you need to understand your statistics. You can download a template that we have on the dashboard at warriortrading.com. Okay, so first and foremost, risk management, right? But stock selection is also important. We can mitigate risk by choosing stronger stocks. And out of the thousands of stocks available to trade on any given day, there's typically fewer than 20 that are actually good candidates for day trading. What makes a stock a good candidate for a day trade is very, very different than what would make a stock a good candidate for an investment or even a swing trade. Okay, day trades, we're looking for very specific criteria. We trade stocks with a reason to run. And look at this chart here with those 4 volume bars highlighted. Those are 4 days that this stock was experiencing above average volume. Tons of volume. And those days coincide with gaps on the daily chart. Okay, there was a reason this stock was in play. Gapping up or gapping down on FDA approvals, news, earnings. Those were catalysts. Okay, that's the type of stock that we're going to trade. So we're not going to trade this stock every single day of the year. We'll trade it those 4 or 5 days of the year or in a 2-year period when it's in play. And the rest of the time, this stock is of no interest to us. So day traders, we trade different stocks almost every single day. But you know what? As a new trader, that's not what I was thinking. I was thinking that I'm going to make a list of my favorite stocks and start just looking for chart patterns. So I'll trade some Apple and some IBM and some Microsoft. I'll have some tech stocks, and then I'll have some, other utility stocks that I'll trade. American Electric Power and U.S. Steel, whatever. Just some of my favorite companies. But that doesn't work for day trading because those stocks usually are not in play on any given day. They might only have 5 days out of the entire year where they're likely to make a 5 to 10% move intraday. Right? And that's what we're looking for as a trader. What stocks today have the potential to make a 5 to 10% intraday move? Okay, so the big stocks, the huge companies, they don't usually make big moves like that, although they do sometimes. So day traders often end up focusing on some of the under the radar companies that suddenly come out with big news. And we have to remember that as a trader, especially as a day trader in this market right now, we're competing against computers. High frequency traders, the computer systems, it's like playing chess against the computer. You will always lose, right? It's a losing battle. You can't win playing chess against the computer. All right, so we know that high frequency trading is accounting for more than half of the volume in the market on any given day. But it's safe to say that high frequency trading will be higher on some stocks and lower on other stocks. So we're better off trading the stocks with less high frequency trading and therefore more retail traders, more regular traders. Okay, so what would regular traders like us gravitate towards? Well, we're going to look every day to see what stock has news. Stocks trading on high volume. All right, tens of thousands of traders, we're all going to be watching these same stocks. And our buying and selling volume is going to be stronger than the high frequency traders. So we're going to end up dominating those stocks on that particular day. And that means that stock is going to be easier to trade and it's going to be more predictable. And ultimately, that makes our job easier. We trade extremes as day traders. That's how we combat the high frequency trading systems. We look for stocks with high relative volume. That first chart that we looked at with those 4 big days, those were high relative volume days. And every single day, there's a stock having an extreme, a once in a year event. And that's why we trade a different stock almost every single day. We're trading the stocks having a once in a year event today. And maybe tomorrow they'll still be in play, and maybe they'll be in play the day after that. Sometimes they'll carry over for a couple of days, and then they'll be out of play until, next quarter or next year even. Or maybe they're out of play forever. We don't know. We don't get attached to these names. We're not trading the fundamentals of the company. We don't really care about that too much. We're trading the technicals. That's what day traders do, right? Investors and swing traders, they may have to focus more on fundamentals, but for us, it's really the technicals. So we're looking for a stock that has the potential to make that big move. And what makes the stock extreme is the high relative volume. A stock that trades on average 500,000 shares a day, that trades 20 million shares today, is trading on way, way, way above average volume. There has to be a catalyst. There has to be a reason for that. It's usually going to be earnings, breaking news, maybe an activist investor taking a position, government news, FDA approvals, SEC investigations, things like that. Those are going to cause a lot of traders to notice this stock. And then there's other certain technical characteristics of a stock, including its float and its short interest, that are always important to take note of. Stocks that are low float are the ones that have the biggest potential to make big moves. This was VLTC that made a move from $2.16. Oh, actually, it was even more like $1. Went from $1 to over $20 in 3 weeks. I mean, that's a huge move. That's insane. But we actually see those kinds of moves several times a year. Stocks with low floats have a very limited supply. The float is the supply. It's the number of shares available on the market. So when a company does an IPO, they release shares. They make a public offering. They release shares into the market that can be traded. If they release 10 million shares, then the company now has a 10 million share float. That's the supply. And those shares are in a pool. And when you buy, you're buying from that pool. And when you sell, you're selling back to that pool. But those are a fixed number of shares. The company can dilute their float. They can add more shares by selling more of their company, doing a secondary offering. And that'll usually make the stock price go down. Or they can do a share buyback where they say, you know what, we're going to make our float smaller. We're going to buy back some of the stock because we think our company is so strong and, you know, we've got extra money, whatever. And that'll usually make the value and the price go up. But the float, that's the supply level. And it's simple supply and demand. When a stock has a limited supply and a lot of demand, price is going up. And that's what we see with a lot of these low float stocks. When they have that combination of a low float, maybe a little bit of a higher than average short interest, and a good catalyst. Your short interest is simply the percentage of the float that's currently short the stock. And for people that aren't aware of shorting, shorting is simply selling shares and then buying them back at a lower price. And you profit when the stock goes down. So when you short a company, you've got the negative 1,000 shares that you sold 1,000, and now you have to buy them back eventually at a lower price. But if the stock surges up, you may end up buying them back at a higher price and taking the loss. And short squeezes are when a stock surges up 100% and you're, hanging out on the beach, you don't even know what's happening, and your broker says, hey, this guy's like going into the red big time, we're just going to cover him. We're going to automatically do it at market price, and they cover your position. You take the $30,000 loss or whatever it is. And they also do that for 1,000 other clients in their, firm. And all those buyers, that just makes the stock go up more and more and more as people are taking losses. Okay, so short squeeze and low float stocks, those are going to be some of the technical characteristics that can result in some really huge moves. Okay, now when we're looking at stocks in any given day, you may see a stock that has news of a buyout. And typically a buyout is going to trade flat, as you can see here, because the value's been determined. If a stock is being bought out at $10, who's going to buy it at $10.50? And who's going to want to sell it at $9.50? The price is $10 and that's determined. So usually buyouts trade pretty much flat. So those aren't going to be one of the catalysts that we trade. As day traders, we follow the volume. We follow it on a day-to-day basis, and we follow it on an hour-to-hour basis. We're always looking for the stocks that have volume right now, because those are the ones that are in play. And trading low volume stocks that have 20,000 shares of volume, unless you're jumping in because there's some news out and you think you're getting in before everyone else, which is okay if that's the case. But typically, if they have no volume, they're not in play. The patterns that we're going to go over work because other traders see that same opportunity to get in with a low risk, high reward setup. All right, so patterns work better on stocks that lots of traders are watching. And they don't work as well on stocks that nobody's watching. So that's why we follow the volume. Okay, so stock selection is a second level of risk management. by avoiding penny stocks, low float stocks, illiquid stocks, OTC stocks. We can focus on safer areas of the market, understanding that day trading is very risky, but we can mitigate our risk. We can avoid the highest risk type of day trading and focus on areas of the market that are a little bit more predictable. All right, so your second piece of homework here is to see if you can find some extreme days on a daily chart of any given stock. What you're going to be looking for are the days with big green or big red candles and lots of volume. Once you find that day, search that date and see what the news was. What was the news that caused that extreme? And you should be able to find a headline or something that correlates with that day on the calendar. All right, so next step is setting up your charts. Okay, so we've talked about some of the fundamental concepts that are really important, right? But let's set up the charts, get that visual going. All right, so we rely heavily on stock charts being technical traders, and stock charts are a form of technical analysis. There's two types of analysis, technical and fundamental. Fundamental analysis is when you look at the actual earnings of a company, the strength of the sector and that sort of thing. And that for us is really not that important as day traders. Instead, we're looking at the technicals of the actual chart. Okay, now I'm a big advocate of using as few technical indicators as possible to avoid overcomplicating what should really just be a simple strategy and a simple setup. All of my charts are candlestick charts. Okay, so these charts are comprised of many little candlesticks, and each candlestick represents price action within a set period of time. So if you're looking at a daily chart, each candlestick represents one day. And as a day trader, we use 1 minute, 5 minute, and daily charts. And some traders will use 15-minute or 60-minute charts. You can really choose any time frame you want, but the most common are 1 minute and 5 minute charts. And of course, always keeping an eye on the daily chart. Some traders will use bar charts or line charts, but most day traders use candlestick charts. All right, so each candlestick will give us 4 pieces of information: the open price, the close price, the high of that period, the low of that period. And the shape of that candlestick is going to give us some information about market sentiment. Okay, that's important. Green candles, the open is always the low of the body, and with red candles, the open is always the top of the body. This is a bar chart. It's not something that I would use, but you can look at it. This is a line chart. Again, not something that I would use. And this is a candlestick chart. Okay, so these candlesticks, for me, each one of them tells me an important little piece of information. And I put together those pieces to help me form my bias of whether I want to be long or short this stock, or whether I don't even want to trade it at all. So some of the candles that we're going to look at are hammers and inverted hammers. Okay, a hammer is going to have a long tail right down at the bottom, this bottoming tail. All right, hammers are considered to be hammering out the base. So this candle, a hammer candle, always occurs at the bottom of a sell-off. The long sell-off with a small body and a longer tail forms a hammer candle. This at the top of a run is an inverted hammer, and although this isn't at the very top, it's still an inverted hammer. That long topping tail, this tells us that buyers pushed the price all the way up here, and then sellers jumped in and pulled it all the way back down. And at the end of this candlestick period, the sellers won. Even though this closed as a green candle, they were able to pull the price all the way back down. So that's a sign of weakness, an indicator that the trend may be about to change. Same with the hammer on the bottom, a sign of strength that maybe the trend is about to change. We also look for doji candles. A doji candle is a candle where the open and close price are almost the same. And there's typically a little bit of an up candle wick and a down candle wick, the upper and the lower shadows. All right, so we keep an eye on dojis, inverted and regular hammers, and long body candles. Okay, long body candles are candles that have a very large body, which is indicative of a lot of strength in the name. Okay, so that means a lot of traders jumped in. It's a very strong candle. We popped up, we surged up, and we didn't look back. So if I see 3 or 4 long body candles in a row, I may start to think that the stock is getting a little overextended. But generally, you want to be in a stock that's forming long body candles. That's the ideal scenario. But if you missed it, then you look for possibly a reversal opportunity. The charting layout that I use has 3 time frames. All right, we've got the daily chart, the 5-minute chart, and the 1-minute chart. I keep the daily chart on there because I always want to remember to step back and look at the bigger picture. The 5-minute chart and the 1-minute chart, they are always occurring in the context of the daily chart. So if the daily chart is very, very weak, it's important to recognize that and to see that. Now, the technical indicators that I use, they're, again, designed to give us some context, to help us understand the current price action. All right, so ultimately an indicator is designed to help give us an idea of the current price action and to sort of help us predict where the price might be going. But you can never rely on technical indicators for your buy and sell signals. It's just, you can't do that. Trading doesn't work like that. We use them to simply confirm what we already suspect. And the indicators that I use start, of course, with volume bars. This just visually shows us how much volume has occurred during a candlestick period. Okay, and just looking at the volume patterns can tell us a lot about a stock. This is indicating to me that this stock probably moved up very quickly, pulled back a little bit, started to come back up, and then sold off again. The green and red just tells us whether the candle opened as green or red, or closed as green or red rather. In addition to volume bars, I use moving averages. The 9, the 20, the 50, and the 200 exponential moving average. And sometimes I take the 50 off depending on what my chart looks like so it doesn't get too cluttered. All right, and you can see these moving averages, what they do is they take the average price of the stock over that period of time. So the 9 moving average is the average price over 9 periods. The exponential moving average weights recent price action more heavily. That means that the moving average will move up a little bit faster as the stock moves up. Like moving averages, we have the VWAP, the volume weighted average price. All right, this, instead of factoring in recent price action, factors in volume and weights that. So what we have is the average price of the stock over the course of the day with volume factored in. So the VWAP is kind of like our equilibrium point. That's our balance point of the stock over the course of the day. It's the average price, factoring in all the volume that's taken place. We also have MACD, the moving average convergence divergence indicator. And this simply tells us whether our moving averages are moving away from each other, which would be indicative of a strong trend, or if they're coming back together, showing that the trend is weakening. Now, I don't really use the MACD that often, but it's something that could be helpful for new traders potentially. Now, the Bollinger Bands, these are quite helpful with timing reversals because 90% of price action is going to occur inside the 2 Bollinger Bands. So when we see a candle outside the Bollinger Bands, it's a good indicator of a potential reversal. And you can see right here, this candle that's circled is up and outside the Bollinger Bands, and this candle here came up and broke up outside the top of the Bollinger Bands. So those are good reversal indicators. Simply seeing the candle outside the Bollinger Band, for me, is something I look for as a reversal. Okay, and lastly, we have the relative strength index. The relative strength index tells us the strength or weakness of a stock. It's measured on a 0 to 100 scale. Below 20 is considered very oversold or weak, and above 80 is considered very overbought or strong. But as you can see this stock here, we remained above that green 80 line for a good period of time here as the stock continued to rise. So, one of the things that some traders will do is they'll look for an RSI above 80 or above 90 or above 95, and they'll just start shorting because they're thinking the stock is extended, it's overbought, it has to turn around. But stocks can continue to run for quite a while, even in these overbought or oversold conditions. So just because the RSI is at an extreme does not by itself make it a reversal indicator. Okay, but it is something that I factor in and consider if a stock has a 90 RSI and we have a candle up outside the Bollinger Bands, we're getting that extension, the peaking volume, then these indicators can help confirm my suspicion that the trend is getting exhausted. But again, it's not going to be just one indicator that gives me the red light or the green light. A lot of new traders will start to look for the holy grail, the perfect combination of indicators that when the RSI is above 85 and the MACD is, below this and the moving average is here, that this works 100% of the time. There's no such thing. There is no such combination of indicators or price patterns that work 100% of the time. If you get into the habit of trying to find the holy grail, what you have to start to think about is learning to accept loss as a simple part of trading. Loss is okay. It's not something that we should be afraid of. It's just part of the life of a day trader, that we experience loss. We learn how to mitigate those risks, keep the losses small, and continue trading. But we can't trade from a mindset of trying to develop a foolproof 100% successful strategy or the perfect set of indicators, because we'll be disappointed. That doesn't exist. All right, now we're going to start looking at some simple intraday chart patterns. And a chart pattern is a low risk opportunity to enter a trade. The more obvious the setup in the pattern, the better. Remember, the more eyes on this chart, the better the resolution. That's why we're focusing. These patterns will all be on the stocks that are in play, stocks that are at extremes because they had news. Okay? We would never look at chart patterns or try to take trades on the wrong stock. So all of these chart patterns we're applying to the right stocks. Okay? This is a flat top breakout, a long period of consolidation. And you can tell from this gray area, this stock had a lot of pre-market price action. It was gapping up. It surged up out of the gates, and then we consolidated. A flat top breakout is when a stock consolidates near the highs and actually taps the high of day several times. We tapped it once, twice, 3 times, and then we've been right under it all through here. And we know, we can just draw this line even without having to draw it, just with our imagination. The resistance is right there at $55. And that's a very common place to see resistance, right at a whole dollar. And look what happens when we break $55. Look at the volume spike. Thousands of traders were waiting for that break to jump in. Some may have been waiting for that break to cover their short position. Maybe they shorted in through here thinking it was going to break to the downside, and they said, well, over 55, I'll just cover it. 55 breaks, they cover, new traders jump into the long side. That's a very clean flat top breakout. And this type of pattern can occur over a period of hours or over a period of minutes. This is a 5-minute chart right here, but this could just as easily be a 1-minute chart. And this long period of consolidation could just as easily be half as long, and it would still be valid, right? That's fine. The longer they flag, the more eyes have the opportunity to see it, but other people are going to give up because they'll just stop caring, they'll stop watching. This next one is a very short flat top. This is a 5-minute. We had this surge up to $57. We tapped it once, twice, 3 times, 4 times, and we're going to say we're going to buy this on the break of the whole dollar. A lot of stocks run into resistance around $half and whole dollars. And this is something that we go over in detail in our full-length trading courses. There's so many things to cover. We're not covering everything in this intro class, but just the basics. So know that it's not uncommon to see this. And when we see this, it's actually very desirable. We get in for the break of 57, and there's a move up to $58. That's a really nice move. With a 20-cent stop, and this goes up $1, that's a 5-to-1 profit loss ratio. That's a great profit loss ratio. You were able to manage your risk. Your stop is the low of the previous candle where this green arrow is. That's your stop right there. Nice flat top breakout. Here's another flat top breakout, and this one didn't end up holding. Okay, so we had a high of 641, and we pulled back. We came back up. We tapped it once and pulled back, and then we burst through it up to 670, but we weren't able to hold that level. And as soon as we came back down, it's an indicator that we simply don't have the strength, and I wouldn't continue to hold the position. I look for these stocks to break to the upside and not break back below that resistance line of the flat top. So the previous two examples, those were stocks that broke and continued. This is one that broke. You could have sold half for profit, which would have been the right thing to do. Adjust your stop to break even on the rest, and you get stopped out break even, and it's a small winner. Even the best patterns don't work 100% of the time, right? Even the best patterns. So we shouldn't be trading anything but the best patterns, knowing that the best patterns don't always work. Subpar patterns will work even less often. So by focusing on the best patterns, we'll have the highest likelihood of success, because when they work, they'll work really well. A subpar pattern, when it works, it's only so-so, and the percentage of success just isn't as high. Here's another flat top breakout. This long period of consolidation right under $8. This again is very common, right under the whole dollar. And then we get the break, the volume comes in, that big volume spike there on the break up to 811. Right? And this one has the combination of a strong daily chart. We have no resistance. Okay, so again, reminding ourselves that every 5-minute setup is occurring in the context of a daily chart. And the reality is, a stock that has a really strong catalyst, really good news, even if it has a weak daily chart, they still usually run. But if they have a really strong daily chart with no resistance, that's just added strength. That just gives us another check mark for, yes, this has home run potential, because it doesn't have any resistance until $12, right? So we could still run another 4 points until it runs into resistance. That has potential. Whether or not it gets there is another story, but it has potential. All right, here's another flat top breakout. This was an incredible stock. This one opened at around $8 and surged up to almost $20 in one day. Over 100% move. I mean, that was absolutely just amazing momentum. So when we have stocks like this, we just look for low risk opportunities. We get this trade here, long over $12. We tapped 12 once, twice, 3 times. We get in here with 25-cent stop, right? We'll risk 25 cents for a profit target of 50 cents, right? 2-to-1, okay? We sell here on the move up to 13. So that's a great profit loss ratio, and then up to 14. And then we get a pullback. And now this pullback is not as much of a flat top as it is sort of a consolidation along the 9 moving average in the form really of a bull flag. And the double top break here at 14.12 does end up breaking and getting a quick move. But you can see that that break was retested on this red candle. So we broke, went up to 15, came back, retested the breakout spot, okay? It held, and then we went off for a second run. So when we see a retest like this is an opportunity to say, okay, well, maybe I missed my entry down here, but we retested, we held that level, that's showing strength, so I'm gonna get in here with a stop at the level. And you can't always do that depending on how much you're risking, but it's something to look for. Another flat top breakout here, showing that long consolidation. This one a little bit under a $0.50, $3.50, $3.39. Another very big mover on the daily chart. Here's another flat top. We came up, we tapped 65 once, twice, 3 times, and when we break it, we're off to $7. I mean, this is a stock that made a 10% move from right here up to the high that got up here over $7. 10% right there, and you're done, right? That is a good day trade. And you've got a tight stop at the low of the last candle. So in addition to the flat top breakout pattern, which is one of my favorites, one of my second favorites are simple bull flags. In contrast to a flat top breakout, a bull flag actually pulls back a little bit more, and you buy on the pullback. So we look for a ramp up, a small pullback, we get in with a stop at the bottom of the pullback. So right here, we would get in this first down here on the bottom of the pullback. We get the move up through 738, from 738 up to 880, again, well over 10%. We get a pullback, actually 20%. 20% move, we get the pullback. We get back in here on this pullback here with a stop below the last candle, and then we ride this up. Now, the difference between a flat top breakout and a bull flag is that the bull flag has this larger pullback. And think of this pullback as a cup shape. See that cup shape in there? We don't usually want to buy the top of the cup, right? When we buy up here, we're buying a double top, and that's risky. It's safer to buy these at the bottom of the cup with a stop at the low. I wait for the first 1 minute or the first 5 minute candle to make a new high before entering these trades. Okay, and then I set my stop at the low and try to ride the momentum back up. Same thing with this one here. You've got the pullback. We don't want to enter it at the high of 348. We want to buy it on the pullback. We've got this cup shape. This is a double top, and you can see the double top broke. It retested, came all the way back down to the initial breakout spot, right? Which is fine because we got in at the right place. But if you bought it here, you would have been up like 10 cents and then down 20. And that doesn't work, right? So this is the little double top, the U shape, the cup shape. Just be cautious of those, and you don't want to mistake one for the other. Okay, so this has a little bit of a flat top on the first setup. 2 candles, 3 candles of pullback, but basically at the high. So you could buy here over 67, the high is 70. So that's basically a flat top. And then this one takes more of the shape of a bull flag because we actually do get a little bit more pullback. All right, and this one actually resulted in an even bigger push on the next leg up. So the entry on these bull flags here is the first candle to make a new high. You have 3 candles up, maybe more, maybe less, a couple of candles of pullback, and now the first candle to make the move back up, we get in. So a couple of candles up, 3 or 4 candles of pullback, and now the first candle to make a new high versus the last candle is your entry with your stop at the low. And you trail your stop back up. Okay, this is another bull flag here. You can see we've got the quick move up, the little bit of a pullback, and then buying the first candle to make a new high and riding this from $15.44 up towards $16. Okay, so with these, I don't wait for the candle to close before I buy. As soon as the price breaks the high of the last candle, the break is what I look for. The break is where I enter. Sometimes when they break it, they immediately pop 20 or 30 cents. So if I wait for the candle to close, then I may miss my entry. Now, be mindful of the fact that stocks can be irrationally strong, and they can also be irrationally weak. So we don't want to get into the mindset of thinking that we know better than the market or that this stock can't possibly go any further, because trust me, they can. Parabolic moves, they're common, and they are fun when you're in them, not when it's going against you though. Okay, this is a move here from $59 up to almost $70. Here's another one from $660 up to $920. These are huge moves, right? And the thing is, we see these almost every week. You know, we see stocks doing this type of stuff. These are stocks that are the right type of stock to trade. They have a catalyst, all right? They've got, you know, the good news. They've got the right combination of low float with a decent daily chart, and all the traders, all of our eyes are on this stock, and we're trading it, and it goes up and up and up and up, and we ride the momentum. So we always want to look for those opportunities, because these opportunities, even if we only catch them, you know, a couple times a month, can produce some huge winners. One of the biggest winners recently was a stock that went from $2 to $55 in 2 days, 3 days. I mean, that's insane. That's a parabolic move, not just on the 5-minute chart, but that continued the next day. They were so strong. I mean, just phenomenal. So when we're lucky enough to see that kind of opportunity, we need to be able to capitalize on it, because those kind of moves from $2 to $55 do not happen every day. This kind of move from $6 to $9, this is more common, and this is more common here as well. All right, now, again, remember that all of these intraday chart patterns that we've looked at are occurring in the context of daily chart patterns. Okay, so stocks with breaking news, they'll often surge through a week daily chart. It's not a requirement that every trade I take has a strong daily chart, but you have to be able to recognize support and resistance on the daily chart, because when we run into it and then the stock pulls back, you want to be able to understand why that happened. Okay, so traders are going to simply look for the most obvious support or resistance levels. So when I draw a trend line, the more times it's being tapped, tap once, 2, 3, 4 times, the better. Tap 1, 2, 3, 4, 5, 6, 7 times. That gives the trend line validity. That means lots of traders probably drew the same exact trend line, right? If you draw a trend line and it only touches in 2 places, you may be the only person that drew it. You saw something, but it's too obscure. It has to be obvious. And when we're looking at daily charts, we're going to be looking for triggers and windows. A window is an open space on the chart with no resistance. These red lines are resistance and the orange lines are windows. So you can see here, from this red line to the bottom of the orange line, there was really not any window. There was nothing in there. So that red line is resistance. And above this orange line, well, we had all of this room. So that's actually a trigger, because once we break over that price, we've got all this room up to here. And this line here, well, that's a trigger also, because above that, we've got all this room to here. So where's the next level of resistance? Well, it's up there. So that's another trigger. We've got 1, 2, 3 triggers in a row. And then we hit resistance, because above this red line here, we've got another level of resistance here. But above this one, once again, we open back up. So we go trigger, 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 resistance, trigger, resistance, resistance, another trigger up here, another trigger, and another trigger. So it's unlikely that we'll break through all 4 or 5, but look at this. The stock tapped that trigger and pulled back. So that trigger ended up being resistance. We couldn't break over it. And the difference between it being a trigger or resistance is really just what's beyond it. But it doesn't mean it won't still be hard to break. But if we break it, we've got some potential. So, I look at these as potential levels that are interesting. Whereas if we broke over like this red one, that's really not interesting until we get up to the orange one. So that's why the fact that it's not as interesting may have more traders a little cautious, so it may not break out. But when you have a stock that's already moved up this much and then comes up to a trigger, it's more likely that you will see some resistance there. Okay, but what we're looking for is home run potential. What are we doing as day traders? We're hunting for volume, right? We're searching for volatility. So when a stock has breaking news and it has a great daily chart with no levels of resistance nearby and several triggers, and it has a low float, and it has a good level of short interest, we've got home run potential. We're checking off all of those requirements, right? And that's how we get an A+ setup. And we don't want to take anything other than A+ setups, because even A+ setups don't always work. That's just part of the deal, right? So we will look for the best quality setups. And that means on any given day, we may only trade 4 or 5 times. We may not trade as often as some other traders out there, but every setup we take has really big potential, and that's important. So how do you make your watch list? All right, it's important to make a watch list every single morning. That's part of being an independent, self-sufficient trader. So we're going to teach you how to do it. All right, every trader needs to be able to make a watch list in the morning. Your watch list will be the handful of stocks that you think have the potential to make that 5 to 10% intraday move. So you're going to start by looking at a stock scanner, right? These are the scanners from Trade Ideas, and we offer these on screen share for all the traders in our chat room. All right, so you're going to be looking at the stocks that meet your criteria for being potentially in play. A stock scanner will automatically scan the market, the thousands of stocks in the market, to look for the specific conditions you told it to look for. So at 8:30 in the morning before the market opens, I'm going to say, all right, stock scanner, I want you to find me stocks that are already trading on pre-market volume and that are already up 5% this morning. And it'll give me back a list of maybe 10 or 15 stocks. And I want to see the ones that are up 5% or more, and I want to see the ones that are down 5% or more, because those are both going to be interesting. When a stock opens up 5% or opens down 5% versus the close of yesterday, a gap is formed on the daily chart. And that gap later on will possibly be a large window for a trigger, right? But right now, we know that the day of the gap, there will be a lot of volatility. Gaps are the result of breaking news, whether it was a big earnings miss or, a pharmaceutical company with a drug that was taken off the market, or, lawsuits, or whether it was a big earnings beat. These right here are gaps. We closed at $34 and we opened at $16. And this again emphasizes that single stock exposure as a swing trader, if you put all your eggs in one basket, can be very risky, right? But as a day trader, we mitigate our risk by holding these positions for very short periods of time. So we don't have as much of a likelihood of waking up down 50%. So this stock was down 50%. It sold off. It was very weak. And you certainly could have traded it to the short side through here. But then we had the day where we came back up. And on this day here where we came back up, based on the daily chart, we didn't actually have any resistance until $34. But we did have our 200 moving average, right? And look, that was respected. We came up to it, tapped it, and sold off. And now on the chart, we've got this gap down here and this gap right here. Okay, so our gap scanners, they're telling us which stocks are looking to open higher or lower pre-market. This will tell us which stocks will likely have very high relative volume. And the scanner's also going to give us the information about the volume currently, right now, the float, the short interest, and the earnings dates. This is my scanner. All right, this is a scanner that we wrote in Trade Ideas. It's available to all of our students. And you can see here the symbol, the price, the float, the percentage of the float that's short the stock. So in this one, ARO, 25% of this float right here is short. So that means 25% of the people are down 5% this morning as this stock just popped up. On this one, we've got 19% short interest. So 19% of the float is down 12% this morning. And then we have the percentage of the gap. This is gapping up 61%, whereas this one's gapping down 17%. And we have the volume. All right, so some of these have a lot of volume and some of them have very light volume. And then we have the number of days we are away from earnings. Okay, so these are all far away from earnings, but these in orange are within 24 hours of earnings, indicating that it's likely an earnings-related gap. This is the relative volume, the average volume of the stock on a given day versus what it is today, and this does not start populating until the market opens. We've got the name of the company, and then we've got the relative activity on social media, which is always good to know. All right, so we take that scanner and we start preparing a watch list. We review all of the gappers and we mark out the pre-market charts. Which ones already have a flat top breakout forming pre-market, or a bull flag forming pre-market, or simply up 30% and look like they've got a great daily chart with no resistance. And we, of course, want to filter out the buyouts because we know they'll usually trade flat. And we make a list of the gappers that have the strongest pre-market charts. When a stock gaps up, we need to see a good pre-market chart, and that means the stock is consolidating near the highs. If a stock gaps up 30% and then sells off 20% and is only gapping up 10%, despite the fact that it's still gapping up 10%, it's not good because it pulled back so much. All right, so we look for stocks that gapped up 30% and are consolidating in the top of that range. The stocks that have the best patterns, we will review the news and we will take notes of any other important details, and then we'll write down our potential entry prices and our stops. So if we're going to enter a stock over $8 and we set the stop at $7.80, we've got a 20-cent stop, which means we want to see a 40-cent profit target. All right, my typical watch list will have 4 primary stocks and usually 2 or 3 others that are secondary, that are interesting. Maybe they were really active yesterday and I'm going to keep them on watch for a possible continuation today. And maybe they'll play out and maybe they won't, but I'll keep them on watch. So my typical watch list will look something like this. And you can find this information on our website. We track all of our watch lists. All right, so ACUR, I'm watching it long, possibly over 130, the pre-market highs, and this was the news on it. It's gapping up 30% with a 34 million share float. GBSN, I'm watching it long, over the pre-market highs, or over the high of the last pivot. Right? That would be kind of like a bull flag. And this is the news, gapping up 8%, but with a 2.6 million share float. And that's a very low float. Right? And some stocks trade with floats of over 1 billion shares. So when you see a float below 10 million, it's a very low float. And then all we have to do is recognize the patterns as they're happening in real time. Okay, these patterns, the bull flags, the flat top breakouts, the moving average pullbacks, the top and bottom reversals, they happen again and again and again. The more often you see them, the easier it will be to train your eye to recognize the opportunity there, to see that, okay, I can set my stop at the low of the pullback and ride this momentum. This is a stock that's really strong and I should be more aggressive, or this one's a little iffy, it's a secondary mover, it's a follow through, and maybe I'll be a little more conservative. And all of that comes with experience, which is why during your first month of trading, definitely your first month at least, it's good to trade in a simulated trading account. Okay, so we're going to combine what you've learned. You know how to manage risk, how to choose the right stocks, how to identify the strongest chart patterns, how to create a watch list, right? We're giving you the tools to be a successful trader. Okay, when I'm trading momentum, I look for the first pullback, the bull flags, the breakouts. When I'm trading reversals, I look for the candle outside the Bollinger Bands after a parabolic move. All of this comes together. We have to build the foundation, and that's what you'll build your, hopefully, successful career as a day trader on. So your homework, next piece of homework, is to begin making a watch list every day. The watch list should be based on the big gappers with high volume and news. During the day, you can add to the watch list if a stock comes into play. Sometimes in the middle of a day, we'll have breaking news. XYZ reports, earnings were leaked, whatever it could be. That stock is now in play. It now has a catalyst, and the volume will come into it. And other times, some of the stocks that were in play from the morning, they won't pan out. The volume won't really come into it the way we thought, and we'll take them off the watch list. So we adjust our watch list throughout the day, but you should start every single morning with a watch list. All right, so now how to buy and sell, right? This is obviously important. So when you're looking at your broker window, you should have a level 1, which is the bid and ask. Every single stock has a bid and ask. That's the level 1. All right, the bid is where buyers can place offers to buy shares, and the ask is where sellers can place offers to sell their shares. So the bid and the ask, it's where the buyers and the sellers come together. As a buyer, you have 2 options. You can choose to sit on the bid price and wait until someone comes to sell you shares that you can buy. Or you can simply buy from a seller on the ask. When you buy from a seller on the ask, you pay a higher price, a couple pennies higher, but you get in right away. And at the same time, as a seller, you can choose to sit on the ask and wait for one of those buyers to come buy from you, someone that just wants to jump in. Or you can say, you know what, I'm just going to sell to someone on the bid. I'm going to just sell to one of those buyers and get out. All right, so you always have those 2 options, to either sit on the ask or the bid and wait, or just to hit the current market price. All right, and this is what the level 1 looks like. We've got Apple's bid right here. We've got a bid of 114.07 with an ask of 114.10. So we've got a 3-cent spread in the level 1. Okay, the 3 cents is the difference between the bid and the ask. So that means if you buy on the ask, you're immediately down 3 cents, because if you wanted to get right out, you'd have to sell on the bid for a 3-cent loss. So stocks that have a really big spread, like 20, 30 cents, those are going to be harder to day trade. We're going to avoid those. We want to trade stocks that have a tight spread because it's easier for us to get in and get out. But as a day trader, we can't trade based on level 1 quotes. This isn't enough information. This is only the first level of information. What we need are level 2 quotes. Level 2 provides market depth, much more than level 1. Level 2 shows the current bid and the ask price, but it also shows you how many buyers and how many shares are lined up, not only at the current bid and ask, but also at the next step down and up. So you see, okay, there's this many buyers here sitting on the bid, and there's this many right below them and below them and below them. And it's the same on the ask. There's this many sellers here at this price and this many above and above and above. That can give you an indication of the strength or weakness of the market. So right here you can see level 2. This is important. We see the 1407 by 1410, right? That's what we saw here. But now we see, oh, there's 2, and that represents 200. There's 200 shares sitting here at 1407, and there's 500 sitting at 1410. So, all right, now we know how many shares are available. Okay, there's also another 100 right here. This is through a different market maker. And then we go down here to 1403, and there's someone sitting there with 1,100 shares as a buyer. So maybe that's a little bit of support, because that's a kind of big order, right? That's a bigger order sitting there. If it was maybe 11,000 or something like that, that would be even more substantial. That would give us even more information. And on this side, we've got a seller of 3,000 shares sitting here at 1411. So that is a little bit of resistance, right? We know this just by seeing and reading the level 2. And now here we have the time and sales, which will show us every single order that passes through. And remember, because we're in this closed environment where we have the float, we have the fixed number of outstanding shares, every transaction is a buy and a sell. There's always someone on the other side, right? There's the closed number, there's a fixed number of shares. So these transactions are red and green based on which price they occur at. Did they occur at the bid price, which is kind of a sale, someone bailing out, and of course someone's buying, but that's a weak. Or did it occur at the ask price, which is strong? So that's why they're red or green. Or sometimes they'll be gray if they're occurring directly in between the spread. Reading level 2 is a very important skill. And we've talked about the importance of recognizing strong chart patterns, finding the right stocks to trade. But learning to read level 2 is also very important. That's something that we'll cover in our full-length trading courses, but there's just too much depth to it to cover right here. So when you place orders, there are a couple different order types that you can use. You can simply use a market order, which will get you in that stock at market price, which means really, it's the current price, but it could be any price because you haven't stipulated the most that you're willing to pay. Then you have a limit order, which says, I'm going to get into this stock, but only at this price. I use limit orders because they're safer. When you use a market order, especially in volatile markets and volatile stocks, which we often trade as day traders, a market order can give you a horrible fill. You think you're getting in something at $8 for the breakout, and you get filled at the top of the breakout at $8.30. With 2,000 shares, you just lost $600 in slippage. Slippage is the difference between the order price that you thought you were going to get filled at and what you actually got filled at. Market orders can result in a lot of slippage, whereas limit orders, you're controlling the amount of slippage that you will allow. So a limit order is going to be, for me, safer and lower risk. Those are the buy and sell orders. And then we also have stop orders. When you get into a position, you can set a live stop. And that stop is going to have a trigger price. So you get in, you say, all right, if this drops below, let's say $5, I'm going to sell and take the loss. So you go ahead, you enter $5 as your stop price, and when that price hits, the broker automatically clears out your position and sells your shares. It's kind of like a safety net to have a stop order. And there are a lot of new traders that fall into the bad habit of holding their winners for not long enough and holding their losers for way too long. So they sell their winners too soon and they hold their losers too long. When you're in that habit, it's not a bad idea to delegate the responsibility of selling losers to your broker, because it's the emotions that are allowing you to hold those losers too long. So by simply putting in a stop order and letting it ride, you avoid falling into the habit of holding losers as they drop further and further and further. You never want to adjust your risk parameters in the middle of a trade to accommodate a losing position. You're down 500 and you say, well, I'll give it another $200. But when you got in that trade saying 500 was your max loss, and now you're breaking that rule, that's a problem. So you trade the plan that you made and you have to stick with it. Now, each morning I prepare my orders. So on my watch list, I usually have 4 stocks that are my top favorites. So for those 4, I type in the symbol in the level 2, and then I prepare an order, whether it's for 1,000 shares or 2,000 shares. I type in the price, I choose the limit order, the share size, and now all I have to do is click the buy button. Preparing my orders helps me create my plan for the morning. I have these 4 stocks that I'm watching. These are the levels that I'm watching them around. These orders are ready to go. Once the market opens, all I have to do is click the send button or click the buy button. Right? And then as soon as I'm in that position, I can start getting out either by selling in profit or by putting in a live stop. And of course, a lot of my trades, I use hotkeys, which again is a little bit more in-depth than we have time to talk about in this class, but they allow you to trade just by simply pressing keys on your keyboard. And that, for a day trader, makes the trades very, very quick, which can help lock in profits when you need to. Okay, so understanding how to buy and sell is, of course, important. It does take practice. It takes a little bit of getting used to. Each broker is a little bit different, which again is why you want to trade in a paper trade simulated account, just to gain practice. You will make mistakes. You'll accidentally short when you meant to sell, and you'll accidentally double up when you meant to sell half. These things happen. You just want to make sure they happen while you're practicing. So when you're trading with real money, you can minimize those kind of beginner mistakes, which I still make every now and then, but it's just something that will happen as a new student, so you want to try to avoid the costly mistakes. Now, the next step is really creating a unified trading strategy based on everything we've talked about, right? A strategy is more than just trading bull flags. A strategy includes knowing your historical data. So one of the first pieces of homework was asking you to start tracking all of your trades. So when you do that over the next few weeks and months, you're going to be able to sort that data and find out your percentage of success on various strategies, various times of day, and all of those kinds of things. That information you're going to use to help guide what type of strategy you need to trade. So a strategy is going to stipulate what time of day you trade. For me, I trade the most aggressively from 9:30 to 10:30, 11 a.m. And by 11:30 going into lunch, I scale down my position sizes. I have to do that. I do that because I make the most money in the first hour, and during lunchtime, I'm more apt to make mistakes or get in trades that I think look good, but then don't follow through because it's the wrong time of day. I'm more aggressive on stocks under $10 and definitely under $20 because I make more money on them. I do better. Right? I know this about myself. I trade more to the long side than the short side, and I trade with larger size to the long side because, again, that's where I perform the best. All right? You need to know this information about yourself, and it'll be unique to you. All of our trading students have their unique aptitude for the market. Some are very good at shorting, some are very good at reversal trades. So you have to find your spot in the market that just feels like a natural fit. And the only way to do that is to practice. So my trading strategy really is composed of 3 sub-strategies that I trade every single day. I trade my gap and go strategy, my momentum trading strategy, and my reversal or counter trend trading strategy. And I teach the details of these 3 strategies, including my entry and exit indicators and all of my trade requirements in our full-length trading courses. In those trading courses, I also share all of the scanner settings that I use to find these setups in real time, which is important. You need to be able to find the setups. This is a gap and go example, a stock that we were watching for a trade over $11, the pre-market high. This went from 11 up to $15. That's a huge move, right? So we got our 5 to 10% mover right out of that. And we knew we had that potential based on the daily chart, the catalyst, and the pre-market chart. OHGI, this was the stock that we talked about earlier. This was a gap and go trade, long from 250, sold on the move to $5, 100% win in 20 minutes. My momentum trading strategy, using the stock scanners to help me find the alerts, right? This was one that we traded in the afternoon, which is a little outside my preferred time of day, but was in the right price range, was the right float, and had the volume. So it was worth taking with smaller size. The trade was from $2 up to $3.60. That's, again, a huge move. Lots of opportunity in that. Another momentum trade here from 275, alerted on the scanner, all the way up to 445. That's just, these are remarkable moves. But we see them again and again. You know, it's amazing to look back at some of these and remember how fun that trade was. And we've got hundreds of them because they just keep happening. You know, these patterns repeat themselves. If not every day, then several times a week. And then I have my reversal trading strategy, and the scanner is designed specifically to help me find reversal setups. With a reversal setup, I buy when the price is below, outside the bottom Bollinger Band, with a stop at the low. This was a higher price stock, got that really nice bottom bounce on it. INFA, another strong sell-off, 9:50 in the morning. The bottom bounce dipped below $46, came back up to 47. That's a 1-point bounce. All right, now I find almost every single one of these trades on the Trade Ideas scanners. And these are the proprietary scanners that I've written over the last several years and customized and fine-tuned, and these are available for all of our full-length trading course students. It's really important to be trading a proven strategy. All right. If you trade a strategy that has no historical data, it's really hard to justify trading with real money or to understand whether or not there's the potential for success. The students in our classes benefit from being able to learn the strategies that we've proven are successful. And of course, everyone has their unique aptitude and different risk tolerances, but we have proven that these strategies can be used both by us and our students to make money from the market. I didn't have the opportunity of having a mentor, having someone that could really guide me and that I could talk to twice a week to ask questions or review trades, but that's why we're doing this. We're giving you that opportunity to help you learn. And it's really gratifying to see some of our students performing so well. We had a student this week that crossed the $100,000 profit mark in the last 3 months of live trading. $100,000 in 3 months of trading. That's huge. That's really huge. We have another student that in the last 7 months, he's now up just about $60,000, which again is phenomenal. We're really proud of the success of our students. One of the things that makes me a great teacher is the fact that I struggled. This did not come naturally to me. It took me 18 months of struggling before I even found moderate success. That experience has allowed me to relate to pretty much all of our students. Some who have come from other courses or some who have struggled for quite a long time before finding us, and I'm able to really help support you, both in the emotional conditioning required to be a successful trader and also in teaching you the fundamentals of successful trading. So all of our students in the trading course, they join our 4-month trading plan. So in the 4-month trading plan, in the first month, you're trading in a paper trade account, a simulated account, risking $50 per trade. and we slowly increase your risk to $200 per trade. And students who have completed those 3 steps in the trading plan, those who have completed it successfully, have built up the skills to earn up to $100,000 a year as a day trader. Seeing students achieve that level of success is incredible. Getting rich quick is just, it's not real. That doesn't happen. Day trading is high risk, but it can be high reward for the students that are dedicated, disciplined, and are able to follow the rules. What we teach are trading skills that can be used for a lifetime. And our goal is to help all of our students achieve the lifestyle that they want, and to do that through their success as a trader. So some final words of wisdom. Day trading certainly requires a very high level of discipline, self-awareness, and composure. You have to be able to make the right decision under pressure. As I've said, I've had days where I made thousands, and I've had days where I lost thousands. I've had days where I lost 3 months of progress in one bad trade. If you struggle at first, don't be alarmed. That's part of trading. The most important thing is that you're trading in a simulated environment. So if you do struggle, you're at least not experiencing the financial loss that goes along with struggling as a trader. Being a professional trader is something that takes time, but I believe is achievable if you're able to follow rules. And unfortunately, that's the problem that many traders run into, is the inability to follow rules. They hold their losers too long, they sell their winners too soon, and they find themselves in this downward spiral. Bigger losses, and never finding a good winner. So we want to turn that around. If you're in that situation, we want to help you turn that around. And it means adjusting your focus. It means learning to accept loss as part of trading and not fear it. It's natural for us to fear loss. It's sort of a natural human emotion, but it really doesn't suit us very well as day traders, because loss is simply something that we're going to see almost every single day. Even on a great day like today, I still lost on some trades. That's part of trading, and I understand that. But a lot of traders will start to allow the emotional roller coaster that losses can bring on to hijack their rational thought. So instead of taking the loss when they know they should, they end up holding it too long. It gets worse and worse. They average down, and then they dig themselves a hole. So learning the emotional conditioning to be a successful trader is just as important as understanding the textbook concepts that we've talked about today. And that's what we help you with in our mentor program, is giving you that twice a week support system to help talk you through times that are difficult and celebrate when things are going well. All right, so what we've talked about in this intro to trading course are really just the basics of trading. We've scratched the surface. We've scratched the surface of a lot of different topics, some of the most important topics, but we haven't been able to go into depth. And so I'd encourage you, if you are interested in trading, to continue your education, continue studying either with us or on your own. If you ever have questions, we're happy to help you out, and you can always reach out to us. Our focus is teaching trading. So if you have any questions, you want any additional help, please feel free to email me, ross@warriortrading.com.